Hello, everyone, and thank you very much for joining us. My name is Charles Badger. I'm the Associate Director Distribution here at Loftus Peak, and I'm going to be your host for this session. This is actually the second in our webinar series, and we've got two main speakers today. Firstly, Alex Pollack, our Chief Investment Officer. So welcome to you, Alex.
Hello.
And also Anshu Sharma, our Portfolio Manager. Again, welcome, Anshu.
Hello, everyone.
Now, if you'd like a replay of the first webinar, just give us a call at the office or via our website, and we'll send that out to you. Similarly to the last one, this webinar is going to follow a Q&A type format. And if you do have a particular question that you want to ask, we have Elaine as our moderator standing by, and she's going to field those questions. But given the time constraints, we may actually have to follow those up post the event. Now, with all presentations, we need to put up a disclaimer, and essentially any stocks information that we mention here is of general nature only, obviously not advice, and we would refer you back to the PDS for any clarification. So what I want to do today is revisit our main strategy and its various sub-thematics. And probably the best way to bring this to life is to actually talk about some of the stocks that we own, which might help reiterate our underlying thesis. Now, before we actually start, I would like to remind you that the fund is available on most of the large platforms and also as an active ETF on the ASX. So in effect, dual access points. Now, the Global Disruption Fund has performed extremely well over the last 5 years in particular. We have had generated returns of around just over 21% per annum, with alpha of around 8.6%. And this is against our benchmark, which is the MSCI All Countries World Index. Now, the webinar also carries 0.75 CPD points. If you'd like to have those, what Elaine will do is send a copy of the webinar and a set of multiple choice questions to you straight after this. If you just then send it back to us, if you can allow us about 1 to 2 weeks in terms of processing time, because we've got lots of people on the call today, but then we'll get your CBD certificate back to you. So let's get started. Now, Anshu, I'm going to turn to you first, and we're going to talk about why quality is so critical. If we look at the global markets, we've obviously had a myriad of things going on. We've got COVID, war, rising inflation, rising interest rates, and all that's really sort of translated to increased volatility. Obviously, investors are concerned and nervous. So why is investing in quality stocks so important now? And just so we're all on the same page, how do you actually define those quality parameters?
Great. Thanks for that question, Charlie. Investing in quality is always important. The difference now is that it's visible now why it's important. And obviously in the environment we are in right now, you got inflation headwind, you got interest rate headwind, you got war going on one end, and you had the markets which have been quite high. So at that point, there's a lot of lack of visibility which investors have. They don't really know what would happen in the next 6 to 9 months, what would happen in the next 2 years, what would happen in the next 5 years. And that point, quality becomes quite important due to 2 points, due to 2 reasons. One is the businesses right now would have financial stress and they'll have business stress. Obviously, they had similar stress from COVID and they were just kind to get out of that environment. And now you are in an environment where they're facing these headwinds now. So in a stressed business environment and a stressed financial environment, you want to be with companies which would have the ability to withstand that. And for the companies to have that ability to withstand that kind of headwinds, we would normally lean towards quality. Maybe, and then I'll explain to you what quality is. But I think what we want to look here, if you look at the chart in front of us, we have put our fund, which has a quality bias, against an index which has a lot of companies which are non-profitable. As you can see, the name of the index is Non-Profitable Tech Index by Goldman Sachs. What you've seen in the last 12 months is that our fund is up about 5%. This is rolling 12 months to 28 February 2022, whereas that index is down about 38%, so a differential of about 43% there. So what has really happened here is this: when you are in a bull market, when everything is going up, a lot of time investors become more lenient with the valuations. They put less emphasis on the valuation. You start hearing things like this company is being valued based on the sale it generates per employee. Obviously, that company has got no profitability, has got no cash flows. So how would you value a company like that? We will say it's got 10 employees. Each employee is going to do $1 billion worth of sale. It's a $10 billion company, or this company would do a $10 billion revenue. So you start hearing things like that in a bull market, and people start to accept that this is a way to value a company. But when you face the headwinds which we just faced or are facing right now, that's where you go back to your basics. That's where you go back to the fundamentals. Is this company making money? Is this company have cash to pay its employees next quarter? Does this company have a balance sheet? And the biggest thing, does it actually have a business model which will sustain this business cycle? And that's what we think has happened here in terms of in terms of the divergence between a fund with a quality bias versus investing in things which didn't have that kind of attributes. Going to our next slide, and then we think that this outperformance which you have had of 5% or not falling that much with the market, or not falling that much with the index of non-profitable companies, the reason for that has been the quality bias of the fund. And what do we mean by quality bias? We're talking about profitabilities here. We're talking about the operating cash flows of the companies. Operating cash flow of the company, if it is positive, that means every quarter, every year, this company is generating enough cash, first to take care of its working capital, secondly to expand, and thirdly to withstand the near-term change in the business which is about to come due to all the disruptions we are going through right now. About 6% of the fund has non-profitable companies. About 2% of the fund is operating cash flow negative. That's a very small allocation towards the risky part of the portfolio. And what that does is our companies have enough cash on their books. They don't have to go out next quarter and try to raise debt or try to raise equity in this distressed environment. If there's a company which has fallen by 50-60% in the last 12 months, now if they don't have the money to pay their employees, they have to go out to the equity market and would have to try to raise equity or money at very depressed levels. They'll have to dilute much more than they should have, or they would have to about 1 year back. And same goes for debt as well. These companies, if they go out now in distressed environment to try to raise debt, the interest rates are increasing, so interest costs would be higher. Along with that, the impact on the profitability would be huge because they're already non-profitable. They will go further right into the non-profitability. So maybe that's why quality is important. Quality is important not just in this environment. Quality is important all the time, but it gets highlighted in an environment like this.
Alex, I'm going to bring you in here. Do you see this correction as different from previous corrections? And secondly, are there any areas you're now steering clear of, or on the flip side, actually investing in?
Yes, and just on the point that Anshu raised, there's a company out there called Nikola. It's an electric truck maker, and that company is talking about raising another between 30 and 50% of its equity at a price which significantly dilutes the existing between 70 and 50% of the shareholders. So that's the point. If you don't raise equity at high prices because your model is not funded, then you need to raise equity at lower prices, and that's a very dilutive thing that happens to existing shareholders. So that's the danger in all that. Of course, it's hard to get debt as well. This correction is, we think, qualitatively different in a number of ways. Most of the corrections of the last few years have been really financial corrections based on, in the case of the GFC, obviously the GFC, and there have been, other issues as well related to that. This correction is actually more about, physical things, geopolitical things. In the first instance, and also it's about inflation brought on by supply chain issues that are COVID generated. So that's a very physical series of constraints that are generating this slowdown and this market turbulence. So that's the first issue, inflation as a result of a physical thing, which is COVID. And then secondly, we've got the Ukrainian difficulties, the Ukrainian war, frankly, which is also generating inflation through higher oil prices, and also further complicating supply chains. So the geopolitical issue behind this particular change in circumstances, and probably most important of all, most of the other corrections have taken place in an environment of, this is the first time we've had a distinctly rising set of interest rates to combat inflation on the one hand, and loose monetary policy, which is seen to be inflationary in its own right over a protracted period of time. So this particular slowdown is different for those reasons. It's qualitatively different. What we are leading towards in an investment sense, and to again borrow from Anshu's commentary, we're really leaning hard into the quality end of the portfolio. So for us, this correction means that we need to be in the durable companies of today and the next 5 or 10 years. And the durable companies of today and the next 5 or 10 years are not the Bank of Americas or the Gazproms, as it were. They are the Apples and the Googles. They are the companies that are replacing, as it were, Bank of America and Johnson & Johnson, which was right for its time back, 10 years ago. But we are in a digital world, and a world which will continue its path to digitize. And the companies in which we are invested are the durable companies that are operating so well in that digital platform. And that's where we want to be.
Anshu, I'll come back to you. These are very difficult times for any professional investment manager. How have you been dealing with the volatility? Can you take us through, I guess, what you've been doing in terms of adjustments and positioning within the portfolio?
So it's been a volatile time, not just for us, not for just the professional fund managers, for the public as well, for the investors as well. So much has been happening in the last 12 months. For that matter, so much has been happening in the last whole decade now. We haven't seen this kind of events happening and so quickly in a decade. So just talking about this particular volatile environment we are in, our strategy or has been simple. So for us, the things available to take care of this kind of volatility are, we can raise cash. And if we raise cash, 2 things happen. First, obviously, our market exposure reduces. And the second thing which happens is, if we have that cash ready and the market is in oversold territory, we are actually able to go and buy stocks. We are able to add to our present stocks, or we actually are able to buy things which we couldn't afford earlier because the valuations were too expensive. So that was one strategy. And within our fund, what we can always do is we would have part of our portfolio which might have non-operating cash flow positive companies, which might have non-profitable companies, or which could have companies which would have high growth, which could get challenged. So what we tend to do in an environment like this, we tend to tilt our portfolio towards quality end of the fund, where we discuss what we mean by quality. So these are the things we have been doing. Looking at this slide of our fund cash exposure over the last 6 months or 8 months, what we have been doing is, because we run a concentrated portfolio and we have close to 25 to 30 stocks in the portfolio, we do all the research which is to be done on those names. We understand their balance sheets, their profit and loss, their business case, their business models, what environment they will do well in, what environment they won't do well in. And then what we tend to do is we back those stocks. Our understanding was for the last 3 quarters that markets are expensive. But what we are seeing in our companies is quite promising, and we want to back these companies. The headwind which the portfolio was facing was a macro headwind, not a micro or a company specific headwind. So what we were doing is going into all the earnings. That's when the earning period starts. We were going almost fully invested or much heavier market exposure. And when we came out of the earnings, we started to sell or we started to reduce our market exposure. That's what you see in the two gray areas in the chart, that going into the earnings, we are almost fully invested, like 2% kind of cash exposure or 3%. And exiting, that's back in October, November last year. And exiting November earnings, we are almost at 12% cash levels. Something similar we did even in January, where we went in to about 5% kind of cash levels from 12%. And then as the earnings started coming in and more headwinds started to appear, specifically related to war, we went almost 23% cash. And then this initial part, which I discussed, that having cash ready and being able to deploy cash at the right time, it is equally important as taking the cash off at the market high. So what you see in this chart is I think end of February, you're looking at close to 10% kind of cash levels we had. We have gone further down there on those cash levels. We are very close to fully invested, or to what we normally tend to see in our portfolio. And what we have done is very interesting. We have added 4 new names into the portfolio in the last 3 weeks. I can't disclose them due to the regulatory requirements, but all those 4 names are up about 25%. And all these 4 names actually have good operating cash flows, good profitable companies. So that's what we do. That's how we've been managing this risk and volatility in the recent times.
Thanks, Anshu. Look, I want to turn to our next section now, which is actually examining some of those traditional industries and the fact that they may be changing. Anshu, I'm going to stay with you. The feedback from a lot of investors has been, those funds that have very high allocations to the tech sector have done extremely well over the last 5 years or so. So wouldn't it be prudent to actually go underweight that particular sector now? How would you respond to that?
There is a small disconnect which we see in the world, and I'll try to highlight that with an example, but essentially it goes down to the question of how do you define a sector? If you go, I think we all know that the sectors are defined by MSCI and by S&P and all the index providers. They like things to be black and white. Company A is an information technology company. Company B is a utility company. Company C is an energy company. That's how they want to see the world. And if you go by those definitions, yes, you can say that we are overweight in information technology. But we do not see the world that way. Our perception of the world is very different than the perception of the benchmark. The benchmarks are normally backward looking, and our fund is more about how the world looks today and how it would look 2 to 5 years from now. That's where we add value. So I'll start with an example, and maybe then I'll take you through what the issues are which funds like us face right now, and why do we ignore sectors and we only look at the end market and we invest based on what the end market is doing. But what we call always is miscategorization leads to missed returns. In this graph, what you see is the yellow and the red lines at the bottom are the financial services companies of the world. They're the biggest financial services company of the world, JP Morgan Chase and Berkshire Hathaway. These companies are about $900 billion worth. The financial services sector in itself is a $9 trillion sector, market cap based. So this is about 10% of that market. And MSCI and S&P, they define these two companies as financial services companies. If it was the year 2008 and the investors or the advisors saw that big fall in the financial services companies due to the global financial crisis, you would have said this is a great time to go and buy some banking exposure because the sector has corrected a lot. And you would have had 2 options. You could have gone a passive ETF of financial services, or the second option would have been you could have picked up some stocks within the financial services sector. MSCI and S&P would have told you these are all the companies which we put in the financial services universe. Please go and pick up a stock from there. And that would have been your stock selection. by doing that, you would have possibly done a annualized return of about 8 to 10% in the last 14 years. If you look at Berkshire Hathaway and JP Morgan, those stocks have gone up by 2 to 3 times in that period. But by restricting yourself while thinking about the banking sector, that banking sector is only about the companies which someone else has defined for you as a banking sector stock, you actually ignored Visa and MasterCard. Visa and MasterCard, both of them in the same period have gone up by 14 to 15 times. Huge differential there. One has gone up 3 times, the other thing has gone up, I'm talking Berkshire Hathaway has gone up 3 to 4 times, whereas Visa and MasterCard cards have gone up 14 times in that same period. And the worst part of this whole equation is this year, MSCI and S&P have a proposal out there where they want to recategorize Visa and MasterCard and PayPal as banking sector or financial services sector company. They want to take it out from information technology sector. That's a sector a lot of people say we are overweight. And they want to put these companies in banking sector. So suddenly the investors have this universe which is about to change. Now they actually have to start thinking that, wow, Visa and MasterCard actually are part of banking. They are not part of information technology. We actually could have allocated more money to Visa and MasterCard initially to get the banking exposure, but we didn't do it. And by not doing that back in 2008, did we do a disservice to our clients by not really trying to understand what the business of these companies was? So when Visa comes in this index of financial services, it would be the second biggest financial services company in the world of $450 billion or $460 billion between JP Morgan and Berkshire Hathaway. One of the biggest company in the financial services was not part of the financial services index for the last 14 years. And it's a listed stock and it was really miscategorized in the wrong sector. So if we would have thought about the sectors the way the world defines the sectors for us, we would keep on missing this kind of opportunities. This opportunity is no different than what happened with Google, Alphabet, and Facebook and Netflix in 2018, where those things were taken out of their respective sectors of information technology and consumer discretionary, and they were put into a new sector known as communication services. So for us, we tend to think about what a company does, what is it disrupting, what its end markets are. If we are thinking of banking, we won't look at Commonwealth Bank and NAB. We will look at them if they're doing something very interesting, but if they're not, we will rather look at PayPal's and Apple Pays of the world, or Alipay for that matter. Block is coming. Mercado Libre has got its own payment channels. That's where the value addition is happening. And we want our clients to participate in that value addition. We cannot wait for the index to come and catch up with us 14 years from now and say that Mercado Libre has a very good payment channel, maybe it should be a payment company. So when someone categorizes us as overweight technology, this is the way we think about it. And I hope this gives some understanding about the way they might also like to question how the sector definitions are done. So for us to avoid this pitfall of being constrained based on the definitions by the indices, we look at the markets based on their end market. We try to invest in our stocks based on what industry are they disrupting, what is their main play here. And we look at our industries in terms of 5G, we look at our industries in terms of data centers. We are trying to understand the way the world is heading towards right now. Looks like everyone would require a data center. Is data center even a technology sector or a sub industry, or actually it is a utility as electricity? That's the kind of questions we are asking. So we think of everything from the end market point of view, and then we go up. A lot of times when we go up, we come overweight in a particular sector as traditionally defined, but not the way we look at that. I hope that helped with explaining this disconnect between our thinking and the feedback we get, Charlie.
Thanks, Andrew. It's a very comprehensive answer. Alex, I'm going to come back to you now. Look, a lot of things have changed over the last few years, recent years. COVID's changed everything that we do. People now work from home, shop online, schools are moved online. Do you think this trend's going to normalise? Are we going to have more or less disruption in the world going forward?
Thanks, Charlie. I'll come to that. I just wanted to say something else on Anshu's excellent answer. There's a saying which is you can't manage what you can't measure. But actually, I want to take it a step further. You can't manage what you can't name. And if you give something the wrong name, it's not just that you misname it, it has profound investment ramifications. If you wanted to have an exposure to Visa card through an index, you would have had a very much lower exposure as part of the index to Visa, because it was information technology, than you would have had you have recognized the end market and bought it in as a banking company. So not naming it properly is not just a kind of cosmetic thing. Failure to name something properly leads to significant underperformance in your portfolio. So it's not just about how you categorize something. Those things have significant ramifications. You can't manage what you can't name. That's important. But to go to your question here, Charlie, the portfolio, the world has changed significantly. We're not going back to a paper-based, world where, invoices are raised on pieces of paper that are sent through the mail, where people, navigate from point A to point B using a paper map. That's all gone, where people go out and buy a tape recorder and buy a cassette tape and tape their, business conversations or, etc. through the tape recorder. All of that functionality has been subsumed in hardware and software, mostly in software, frankly. And so we are not going back to a paper-based environment. The world is digital and it will remain digital, and all of the systems that exist in the digital world will only become more powerful and more ubiquitous than they are right now. So, we saw as a result of COVID, people working online, less necessity to actually physically travel into the office, etc. This webinar itself, doesn't entail anything like the travel requirements that would have been. So that's less, petrol burned, and less carbon in the atmosphere. There's a whole lot of, we are not going back to that previous world. We're in this world right now. And this slide really shows the difference between what we're investing in and what some of the concept stock companies are investing in, or the concept stocks themselves. What you are looking at here is revenue growth relative to prior corresponding period for a series of companies that are in the portfolio: AMD, CrowdStrike, Alphabet, Google, Facebook, Netflix, etc. And what you can see are very strong percentage changes on prior corresponding periods for each of these companies. We buy growth, and it's tangible growth. It's growth in revenue, which leads to growth in operating income, which leads to growth in returns to shareholders. That is the difference. It's a disruptive portfolio, it's a digital portfolio, but it's always got both eyes firmly focused on cash flow and cash flow generation. And that's the difference.
Thanks, Alex. Look, I want to move to our next section now, which is having a look at the type of companies that best positioned to tackle inflation. So it's a very big topic. If we look at the macro view, we're obviously seeing inflation rise globally now. The central banks are starting to respond with higher interest rates, obviously. But how will inflation impact on the stocks that we hold in particular, and what are you looking out for? Alex, I might turn to you first on that one.
Yeah, I mean, it's still all about quality. It is still all about quality. One of the characteristics of companies with great quality are moats. Charlie Munger famously talks about Google and this idea that every time somebody clicks a Google search, that the clicking on that search actually expands the Google moat. And he calls the Google moat one of the largest he's ever seen, and it expands it because in doing the search, you actually provide Google with more data about you yourself and what your preferences are, and that enables Google to advertise more effectively to you. Imagine a company coming in with a search product today and not having the data behind the data for every restaurant in the world, the data for every train timetable, the data for every person's search history in the world, that it would be an enormous moat that Google has. And so we look for companies in this inflationary environment that have these kinds of moats. And there's a number of them. So we talked about Google just now, but then Apple has a moat. The Apple moat is the ecosystem itself, by which I mean, there's 1.4 billion account holders of Apple products right now. If Apple wants to launch, Apple Pay, it doesn't launch it to us, to 100,000 people in a given geographical market. It has the ability to make public the launch of this product to 1.4 billion people. So, the ecosystem, the ability to launch new products like Apple Pay, like the Apple Watch, like the headset, the AirPods, that is a moat in itself. The ecosystem is a moat, and it's a tremendously powerful moat. John Deere has a tremendously powerful moat. Because the agriculture concerns farmers all around the world use John Deere equipment already. So adding data capacity to John Deere tractors so that that enable precision farming, the depth at which seeds are planted, the pesticides, soil makeup, moisture content, all kind of mapped to all the other, areas of the world that have got similar kinds of planting requirements. That's a significant advantage for an agricultural concern now, one that they cannot do without if they're doing a large-scale planting. Qualcomm, I think Andrew will talk about in a moment, and 5G. And I think, I started to talk about the semiconductor moat. And that is in itself an enormous sector of the world that is becoming so important and will only increase in importance. I think I'll hand it over to Andrew here because he's much better at this stuff than I am.
Andrew, just before we go to you, and thanks for that, Alex, I guess one thing I want you to address, if you can, for the audience, is that we actually hold a fairly large overweight in the semiconductor space. What's the reason for the overweight? And I guess as part of your answer, what's the outlook going forward?
I think before answering question of semiconductors, so obviously in an inflationary environment, the companies which Alex talked about, we want to be with the companies which are the price makers and not price takers. So a lot of the companies we invest in have a good pricing power. First, they got pricing power. Second, they are actually able to pass on the cost to their clients. So that's a very important place to be in a rising interest rate environment and rising inflation environment, along with obviously the things we talked initially, the quality part of the things. You got to have cash to pay your employees tomorrow before they leave you. So quality and along with that, you want to be with companies which can maintain their margins essentially. So that's where we have placed our portfolio towards. Coming to semiconductors, why we have such a big exposures to semiconductor, and along with that, what's this semiconductor moat? Essentially, what we feel is, if you look at investors' portfolio, if you look at a lot of funds around us, the exposure a lot of them have towards semiconductors seems quite low to us. We said that we invest in the world of today and what would happen 2 to 5 years from now. The world we all are living in right now is much more connected world. Your kids are on iPads in the school these days. You are getting the latest update of your train, which is getting late, or your ferry, or your bus on your phone right now, because the bus has a chip inside it, which is talking to your phone. Or it's just talking to a data center, and data center is talking to you. The tractors Alex talked about are talking and telling something to the cloud at the back end. And this 5G, which we are talking about, this is all about, again, about chips. all the conversations a lot of us are having on social gatherings now about electric vehicles, that is a huge increase in the amount of chips. I think it's about 8 times increase in amount of silicon or chips which would be required in the cars. So this is the world we are living in right now. This world has much more silicon exposure than a lot of the portfolios around us. So if we look 2 to 5 years from now, this is not going to go south. It is going to go further up. We'll get more connected. Projections are that from 20 billion connected devices, we would reach 1 trillion connected devices over the next 15 years. So with all that background, we want to be overweight semiconductor, but that all is stories. What are the numbers? What are the fundamentals which are backing us to be bigger in semiconductors? There are a lot of things. First thing which Alex talked about, the capex. As TSMC, one of the company we invest in, is going to invest $110 billion worth of capex in the 3 years. That is last year and these 2 years. 110 billion, already a very big number, but to put that in context, this company invested in total $98 billion of capex from 2011 till 2020. In the next 3 years alone, it's actually going to put the same amount of more capex than what it has done in the last whole decade. Something is changing here, and we are putting our portfolio towards things which are changing and which can benefit from that. Second, when we look at here all the earnings of a lot of our companies in the semiconductor space, all of them are saying that chip shortage continues. Our margins are expanding. We have better visibility into our clients' pipeline of what products they want and what kind of chips we have to provide them, what demand is there. Along with that, the average selling price of our chips are increasing. That's another reason. So fundamentally, you have higher capex, which is a moat in itself. You don't expect any company to come tomorrow and start competing with TSMC, which is what to do $110 billion of capex, and which comes with the know-how of last 30 years to be the world's most best semiconductor fabricator out there. So this capex alone creates a moat. Along with that, the demand which all the companies to which TSMC and Samsung provides those chips, the feedback they are giving everyone is that we are sold out. Our clients are happy for us to give us advance right now for us securing the capacity six quarters down the line. So these are very important things which has made us go high in the semiconductor sector. We always say that that chips is the oxygen of the world. When the chips production stops, the cars are left on the port because they cannot have an infotainment center inside the car, and you can't sell that car. Your car, if it gets some issue and it breaks down, and you have to take it to a mechanic, and mechanic tells I require a particular part which has got a chip inside it, and that is not in production, your car could be out of operation for the next whole year. So chips are extremely important. I think that's how you see it, but this is important in medical, it's important in mining, where you're doing driverless trucks are being driven. And along with that, then comes the question, market is perceiving this chip, whatever is happening in the chip sector, to be a cyclical trade, that chips go in undersupply, then they go in oversupply. And whereas we look from the point of view of 5G, from data centers, from connected world, from electric vehicles, we see a huge expansion in the addressable market for these chips, that the demand is very high into the future. So when you have this disconnect of a cyclical industry, of an industry being valued as a cyclical industry, and we have a view that this industry actually is it's in a secular trend, there would always be a huge disconnect in the valuation. That is because your growth assumptions would be very different than the market's growth assumptions. And when you put that into perspective, the valuations, the way they come from our discounted cash flow models, that makes us go overweight in the sector, and it actually gives us comfort in terms of defense, which these companies would bring because the valuations are so appealing right now.
Look, I'm just conscious of time. We are now moving into the last part of the agenda, and that's looking at what sort of thematic tailwinds can actually weather this storm of interest rates, inflation, etc., as we mentioned. Alex, I might just ask you a simple question if I can. We've got advisors and brokers in the audience, and when they're allocating, I guess, funds globally, why should they consider Loftus Peak? And what do you think the key differentiators are from us versus other funds out there?
Yeah, thanks. And just to touch on that point of Anshu's, silicon content in cars is going from nothing, 5 years ago to $3,000 a car in the next 5 years. That is a secular growth trend, a secular driver that simply wasn't there. Silicon is part of our lives going forward, and that's not going to stop, and that underpins, our kind of bias. But the answer to the question in these difficult times simply is, as the graphic says, Charlie, set the quality to max. So, stick away from the stuff that's cash flow challenged, that's balance sheet challenged, that's actually business model challenged. And that last one is actually almost the most important one. Stay with the stuff that's got the business model that is going to be the durable business model of the next 5 to 10 years. And what we see as the durable business models of the next 5 to 10 years is the provision of the tools to roll out auto, cloud computing, by which I mean, businesses all over the world are moving from IT on their own premises to a devolved IT in the cloud that's always on, that's charged for by the second, that's available to every employee around the world, that's available to every user around the world, because it's a globalized world. So be in data centers and cloud. Be in companies with great ecosystems, be in companies with pricing powers, be in companies that are the durable companies of the next 5 to 10 years. And that those companies, you want to be in them as much as you can. So you want to set the quality to max. And I think that is the way through this.
Excellent. Thank you, Alex. Look, I'm keeping a very keen eye on the clock at the moment. So that actually brings us to the end of the webinar. Thank you very much to both Alex and Anshu, and of course to everybody that's joined us here today. If maybe I can leave you with a couple of quick takeouts. Obviously, the global markets have been indiscriminate in the way in the selling. But here at Loftus Peak, we've got a very set discipline process and approach, and hopefully you understand how that works now. That keeps us on track. This is also based on our risk ranking and DCF modeling, which is part of the way that we try to generate alpha. So we explained that in more detail in our last webinar. And again, if you'd like to get a replay of that or a copy of that replay, just let us know. Also, if you're looking for any more information on the fund, whether it be performance stats, external research, quant, whatever it might be, just contact us at the distribution team. You can see that information on the slide. And look, on that note, thank you very much for joining us today, and we look forward to seeing you at our next quarterly webinar. Good afternoon.
Thanks, everybody. Thanks, Charlie.
Everyone, thanks for your time.